Hi, this is Kirubakaran Rajendran. Welcome to another video with Groww. So in this video, we're going to talk about option selling versus option buying. So which is better? What is the advantages of using an option selling strategy, or what is the advantages of using option buying strategy, and what are the disadvantages? When one should initiate option buying, when one should initiate option selling. So these are the things we are going to discuss in this video. So when it comes to option trading, so everybody is confused of which one to choose. Do I really need to go for this option buying, or do I need to go for this option selling? So based on your risk appetite, based on your capital, let us see what is the right instrument that is suitable for you. And also we'll address, as I said earlier, we'll address what are the advantages of option buying and what are the advantages and disadvantages of option selling, when to buy an options, when to sell an options, do's and don'ts in options trading, and what overall risk involved in both option buying and option selling. So we'll address all these things. So first and foremost thing with respect to option buying and option selling, so there is a major difference in the overall transaction that happens. If you're an option buyer, you are the one paying the premium. So if you see, say suppose if Bank Nifty is trading at around 40,000 level, and if you wanted to buy a call option at 40,000 level, then if that 40,000 call option is trading at 100 rupees, then you are the one who's paying that premium of 100 rupees. So if you are an option seller, you are the one who are going to get that premium. So if you see that, okay, there is an 100 rupees of value for a 40,000 call option, then you as an option seller, you get that premium. As an option buyer, you pay that premium. So 100 rupees into lot size is the amount that you pay as an option buyer. With respect to option seller, you say whatever the margin that is required for that specific one lot, you pay that to get that premium. So this is the fundamental difference between an option buying transaction and option selling transaction. So let's see what are the pros and cons for option buying and then option selling. So with respect to option buying, the first and foremost thing is, with respect to theory, it always says that option buying is a limited loss, where there is a profit potential of unlimited profits, but overall loss is very limited with respect to the premium that you pay. Say suppose if the premium is 100 rupees, then the maximum amount that you can lose is that only that 100 rupees. So there is always a limited a risk that comes with respect to option buying. And also the profit potential, if the market goes in your direction, if as long as the market keeps going in your right direction, you tend to make huge profits. So overall the risk reward ratio favors the option buyer, and the risk or reward potential, overall reward potential, is also much higher when it comes to option buying. And the third thing is the capital protection. The capital requirement to get started with option trading as an option buyer is very, very minimal. Even someone with 5,000 rupees to 10,000 rupees can easily do an option buying trade, whereas with respect to option selling, the required margin is very, very high. So these are the advantages of option buying. So what are the disadvantages of option buying? So with respect to option buying, the chance of making, the probability of making a profit is very, very minimal. So only 1/3 of a chance is there for an option buyer to make profits. Consider you are going to initiate a trade, and say suppose you are having a bearish view in the market. You expect the market to go down. So what are the three different scenarios that are possible? So with this three scenario, the market can either go up, or it can go down, or it can stay sideways. So as you are having a bearish view, and if the market goes up, then your direction is wrong, your expectation is wrong. So obviously you're going to lose money as an option buyer. If the market goes down, like as per your view, where your view is market is bearish, and if the market goes down, you are right, and your position gets to make money as an option buyer. So you would have obviously bought a put option. So when the market is going to go down, it is going to appreciate. So you're going to make profit out of it. But if the market stays in sideways, it neither moved up nor moved down, then in that case, you are obviously going to lose money because of theta decay, where the option decays slowly. So obviously your position will lose money. So market going up, going down, staying sideways. Out of these three different scenarios, only one scenario, when the market goes down, when your direction is right, you tend to make money. So when the market is going up, where your direction is strong, or if the market stays sideways, in both the scenarios, you're going to lose money. So out of three scenarios, you are going to make money in only one scenario, when the direction is right. So that's why the probability of making profits with option buying is very minimal, and also the trend has to be really big. Even though your direction is right, the movement has to be big enough so that the option prices will appreciate, And also the movement has to be quick and swift. It should happen very quickly, then only the option premium will appreciate. And also, since the decay also plays a vital role with respect to option buying, you can lose all your capital in just one trade. So when you try to buy an option, when you put all your capital in just one trade, if the movement is not in your favor and if the movement is not so swift and quick, then you can lose all your money in one trade. And obviously time decay work against you. So time is your friend only if you're an option seller. Time is your enemy if you're an option buyer. So the more you wait for the direction to go in your favor, obviously the more decay happens, the more money you lose as an option buyer. So these are the major disadvantage with respect to option buying. So with respect to advantage for option selling, it gives you a high chance of making profits. The probability of making profits is comparatively higher with respect to option selling than option buying. Because consider the same scenario which I've explained earlier, where you have a bearish view. So now instead of buying a put option, you are selling a call option. So in this case, what will happen? So after having a bearish view, you initiate this call option, you shorted this call option. If the market goes against you, if the market goes up, then you tend to lose money with respect to your call option. So obviously you have to come out book losses. If the market goes down, which is as per your bearish view, if the market if the view is right, and if the market goes down, your call option will tend to decay. So obviously you will make profits. Now, if the market neither moving up nor moving down, then in that case, what happens is your call option will still decay because of the time decay process, where because neither moving up in your direction or going down, so obviously the overall premium will decay, so you tend to make profits. So out of three different scenarios where market going up, going down and staying sideways, two scenarios you tend to make profits. Only when the direction is wrong, you tend to lose money. So that is why the probability of profit is higher for option selling than option buying. And the second thing, the more most people choose option selling is because of the consistency of profits. Like all you have to do with respect to option selling is you just don't need to figure out where the market is going to go. You just need to figure out where the market is not going to go. So as long as the market is trading in a very tight range, you tend to make profits with option selling. And you have a controlled risk, like even though it says that overall option buying is limited risk, option selling is unlimited risk. If you have a predefined stop loss or if you use any specific hedge, your overall risk is totally controlled. And even though the capital requirement is relatively higher in option selling because of a huge margin, you can buy these OTM options to reduce the overall capital requirement. And as I said earlier, time is money when it comes to option selling. So the longer you hold with respect to an option, the higher the decay happens. So these are the things that you need to consider in your mind when you're dealing with option buying or option selling. So this is one such example where you could see an option buying instrument moving exponentially from 20 rupees to 200 rupees in just one day. So this is the open price and the arrow mark mentioned is the close price. So the profit potential with respect to option buying and option selling, it will always be higher for option buying than option selling, because with respect to option selling, whatever the premium that you receive, that is the maximum profit that you are going to get. But option buying, when your direction is right and if the movement is also very quick and very fast, and to a greater extent if the movement is big enough, then you tend to make 10 times, possibility of making 10 times return is highly possible with respect to option buying. And the next thing that we need to consider is implied volatility. So IV is kind of a measure of uncertainty or fear. So IV is an important factor to consider if you are going to deal with option selling or option buying, be it whatever it is. It is because, see, why do people get into options? Is mainly because to protect their overall portfolio, or option is mainly used by large institutions as a hedge mechanism. They just wanted to protect the overall portfolio from downside. So when does this downside happens? So when there is huge uncertainty in the markets, people tend to panic. So once they tend to panic, then they take all these irrational decisions. So that is when these IV comes into picture. So these wicks or IVs, so it plays a vital role because it calculates what is the overall fear that is there in the markets. So the higher the fear, higher the option premiums. So for an example, consider in case of any kind of quarterly results that is going to announced. So for an example, a company like Reliance, company like HDFC, if it is going to come up with the quarterly results, there will be panic among short-term traders because they never know if the market is going to go up or go down. So how it's going to reflect with respect to the stock price of Reliance or HDFC or its option premiums. So in order to protect their downside of portfolio, they go and buy these options to hedge their overall portfolio. Because of this, because of the demand, the premium prices increases. So as an option buyer, you always notice when you try to buy an option before an event, then these IVs would have increased. So you would have paid a higher prices to these option strikes, option premiums. So next day, once the results are announced, these option premiums will tend to decay a lot higher. They tend to lose more money because yesterday the premium would have been 100 rupees. And tomorrow, even though if there is no movement in the stock price, that 100 rupees would have gone down to 50 rupees or 60 rupees. So there will be a drastic decay in premium post event. So always keep this in mind. If you are an option buyer, never buy an option before an event. It will always be priced at a higher price. So do not buy an option before an event. Always try to sell an option before an event and try to buy an option once this IV cools down, once the overall premium, overall panic goes down, overall fear index goes down, then that is the right time to buy an option. And lastly, there are certain things that you need to keep in mind when you're doing options trading, be it buying or be it selling. Say suppose if the bank nifty or nifty opens gaps down tomorrow, so when it gaps down, then automatically it looks like market is going to go down. So what happens is most of the buyers will tend to think the market is going to go down, so they'll go and buy a put option. But that is not the right way, because as I said earlier, whenever there is uncertainty, these option premiums tend to shoot up. So at the time of market gap down, what happens is all this put options premium would have already spiked up and much higher price. Then as an option buyer, you are paying a much higher premium to get into a trade. So the IV would have increased, option premium would have increased. So you are paying it's kind of buying an overpriced asset. So don't try to buy an option when the market is going down or when the IV is increased. So instead, what you can do is you can initiate an option selling trade here. So you are expecting that, okay, market has gone down and you are having a bearish view. Now, instead of buying a put option, if you have shorted a call option, what would be the possible outcomes? So if you shorted a call option, then in that case, what happens is because of this sudden spike in the premiums and because of increase in the VIX, both call option and put option premiums would have increased. Now, after the gap down, what happens is the IV tends to cool off. So you are initiating a trade by shorting the call option at the start of the day, where the premiums would have already shot up, where you are shorting at attractive premium. Now, if the market tends to go down, you make good returns because your call option will tend to decay much higher. So compared to buying a put option, shorting a call option is better. Now, if the market stays in sideways move, then in that case, what happens is your call option will tend to decay a lot faster, because market is neither moving up nor moving down, and your spiked call options premium will slowly tend to decay. Now, if the market started reversing and if the market goes up, where it is completely going against you, where you have shorted call option and market is going to go up, then in that case, you tend to lose money, but not significantly, because as long as the market keeps moving up, the uncertainty will keep going down and the IVs will also cool off. So the premium which were there in the morning will not be same in the evening. So obviously the premium will also slowly decay. So there is a chance that you might make profit also in this trade, even though the direction is wrong, because of the increase in IV in the morning. So to conclude, always keep this in mind if you're an option buyer or option seller. If you're an option seller, always try to initiate a trade when the IV is higher. And if you're an option buyer, always try to initiate an option buying trade when the IV is lower. So these are the things that you need to keep in mind with respect to option buying versus option selling. So you would have clearly understood what are the risks that is involved in both the parameters with respect to option buying and option selling, and what is the overall reward that you would get dealing with option buying and option selling. So hope you found this video really helpful. So in case if you guys have any questions or comments, please put it in the comment section. I'll address it. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.